Welcome to this virtual reunion session. Today, we're pleased to be joined by Professor Andrew Lo. Andrew is the Charles E. and Susan T. Harris Professor of Finance and the Director of the Laboratory for Financial Engineering at MIT Sloan. It is an understatement to say that he is truly an expert in finance, and in particular, that would be because he originated the adaptive markets hypothesis. He will talk to us today about the financial implications of the COVID-19 crisis and how we can look forward beyond 2021. Andrew, we're so delighted to have you here today. Please join us and take it away.
Great, thanks, Patsy. It was wonderful to be here with all of you today. And I want to begin by thanking Kathy Hawks and the Sloan Office of External Relations for putting on this event and inviting me to participate and be with all of you today. And on behalf of Kathy and Dave Schmidtlein, I want to thank you for joining us and being part of this remote event. Obviously, we're very disappointed that we can't see all of you in person. I, in particular, always get a real charge out of seeing former students and colleagues. And this is one of my all-time favorite events of the year. So it's, it's very disappointing for all of us that we can't be with you in person. But I'm hoping that this is going to be one of the last online events that we do for you, and that the next time around we'll actually be able to see you in person and be able to interact much more directly. I'm hoping that all of you are staying safe and healthy, and you're preparing for the end of the pandemic. I think that there's a lot for us to be thankful for and to look forward to. But what I'd like to talk to you about today is the financial perspective of the pandemic, both before, during, and more importantly after, and what we have to look forward to. And it's a bit of a challenge in one sense, because the traditional models certainly didn't account for pandemics. But I think that there's actually a way to make sense of all of the events over the last year and a half. And that's really through this lens of adaptive markets that Patsy mentioned. So what I'm going to do is just to take you through my perspective as a financial economist about how to think about pandemics. And to do that, let me switch views and show you this is the interface that I use for much of my teaching over the course of the last year. That's a whole nother topic unto itself that hopefully we'll have time to get to at some point in the future. But I want to talk about the framework that most of us have used in finance over the course of the last few years, which is the efficient markets hypothesis, the fact that prices fully reflect all available information. And as I'm sure all of you know, there's a pretty significant gap between the efficient markets hypothesis on one end of the extreme and the fact that people do behave irrationally. And if you had any doubts about that fact over the course of the last few months, I think you have seen many, many examples of that. And this gulf between market efficiency and behavioral finance has been around for decades now. And I have to say that as an economist that believes in both of these schools of thought, it's a little bit frustrating and kind of like when you were growing up and listening to your parents argue. You love them both and you just wish they would stop fighting and get along. And so that's what I want to describe to you today, is a way of somehow reconciling these two extremes, and to do so in a theoretically consistent and intellectually satisfying manner. And so let me summarize the perspective that I'm going to take, which is the adaptive markets perspective, which I put together in a book a few years ago. The basic idea is that the traditional finance framework is limited. It's not wrong, but it doesn't encompass the sum total of our experiences. And in particular, it's focused way too much on the kind of quantitative physicists' approach to modeling financial market dynamics, and really not recognizing the fact that markets really are an organic entity, a living, breathing set of individuals interacting with each other. And with most organic systems, in a stable environment, you will eventually reach some form of stable equilibrium among those particular species. You'll get stable financial policies. That's the world of the efficient markets hypothesis. But when the environment is changing very rapidly, then you need to have dynamic policies. And that's really what the adaptive markets hypothesis is all about. And the fact is that the current environment is highly, highly dynamic. And so we really have to figure out ways of adjusting to those kinds of market changes. Politicians are often fond of pointing out that it's the economy. But in fact, I would argue that evolutionary biologists should be telling us economists and politicians that actually it's the environment that often shapes market dynamics. And so I'm going to use the lens of adaptive markets to think about what COVID-19 has meant for our financial system and what we can expect over the course of the next few years. So the basic idea behind adaptive markets is pretty simple. It's taking the principles of evolutionary biology and ecology and applying that to financial systems. Obviously, individuals act in their own self-interest, but we make mistakes. In the words of Herbert Simon, we satisfice and we engage in acts of bounded rationality. And so we learn and adapt to those kinds of market dynamics. And ultimately, those heuristics that we use are what give rise to things like competition, adaptation, innovation, and eventually the kinds of financial market gyrations that we observe. The evolutionary biologist Theodosius Dobzhansky once pointed out that nothing makes sense in biology except in the light of evolution. And I would argue that, just paraphrasing Dobzhansky, nothing makes sense in finance except in the light of adaptive markets. So that's the perspective that I want to take. And I'd like to do so now and apply it in a way that will ultimately allow us to reconcile these two warring factions of efficient markets versus behavioral finance. So I'm going to start first with a little bit of historical context. And after that, talk about financial market dynamics and implications of the pandemic. So the question that we are all asked back in March of last year was, has this happened before? And the old saw that history doesn't repeat itself, but it often rhymes. I'm not quite sure who said it. People attribute it to Mark Twain, Will Rogers. But the bottom line is that there are some elements of truth to the fact that certain recurring themes can be identified in our history. And so the two examples of things that have happened before that we are now observing within the course of the last year or so is, number one, the 1918 influenza pandemic. Some people call that the Spanish flu. It turns out that that's a misnomer. It didn't start in Spain. It was first reported in Spain because it occurred during the First World War, and many countries had news blackouts, so they couldn't report about it. But the 1918 influenza pandemic is probably the closest thing to what we experienced over the course of the last year. And the second historical event was, of course, the 2008 financial crisis, where we observed tremendously significant decline in GDP growth, employment, and so on. So I'm going to talk a bit about these two and describe the similarities, but also describe the differences. And from making that comparison, we're going to understand far better what we've been going through over the course of the last few months. So let me start with the 1918 pandemic. It turns out that an economist by the name of Thomas Garrett put out a very interesting research paper back in 2007, looking at the economic effects of that 1918 event. And what he concluded was kind of surprising, at least to me, when I first read this paper. The conclusion is that most of the evidence indicates that the economic effects of the 1918 influenza pandemic were short-term. And in fact, the two most significant effects were actually a shortage of labor that actually led to an increase in wages and then some kind of a impact on human capital for the individuals that were born right after that. But that was it. In terms of GDP, growth, employment, the effects were temporary. Now, part of that was because the pandemic was not advertised. It was not communicated broadly at the beginning because of that news blackout and the fact that we were in the midst of a global conflict. So let me show you one instance of the financial market dynamics and how different they were and relative to what we expected. So I'm going to show you the Dow Jones Composite Index. These are daily returns of the Dow Jones Composite from 1916 to 1922. And so it'll be a growth of $1 invested over this period of time. And I've got two dates highlighted here. April the 6th, 1917, that's when the United States declared war on Germany and entered the global conflict. And April 5th, 1918, about a year later, that was the first instance where there was any news reports of this influenza virus that was going around. And it was in a small newspaper in Kansas because that's where the first outbreak apparently occurred. So let me just show you what happened to the stock market during this period of time. And keep in mind that we had this news blackout so that it was not advertised. So first of all, if we take a look at what happened between the time we declared war and the time there was this news report of a flu starting to go around, stock market went down, went back up. So it was down a little bit. But over the course of the next few months, it was going to recover. Now, on April the 5th, 1918, this report that 100 soldiers in Camp Funston, Fort Riley in Kansas, ended up contracting the flu. It turns out that that happened a month ago in March of 1918. And so the flu pandemic really took shape in the United States during that leading up to that summer and fall of 1918. So the first phase was from June to around September, where it started to spread like wildfire. After that, 100 soldiers that contracted the flu in Kansas, about a week later, that number was about 500. And then it started to spread even more quickly after that. Now, the second phase turned out to be the most deadly. That was the fall and winter of 1918. During October of 1918, in that single month, 195,000 Americans died. 1 month. And you notice that there's a red dot in that period. That was November, where we actually declared victory and celebrated the end of World War I. Now, remember, there was no reports in the news. The article about those 100 soldiers in Camp Funston, that was in a local paper. That was not national news. And there was no news about any kind of epidemic or pandemic. So in November, when we celebrated the end of World War I, that celebration occurred in the streets. And here's a photograph of that day where you can see that there was no social distancing, there were no masks. And so you can imagine how quickly things spread, even at that point where we were in the midst of that second wave. And then the third wave occurred after that. And that second red dot there is June of 1919, when President Woodrow Wilson went to Paris to sign the Treaty of Versailles that officially ended World War I. At the end of this process, about 675,000 Americans died from this particular pandemic. Around the world, we don't actually know how many people died, but estimates range from 25 million to 50 million people. And you have to keep in mind that although we're now approaching about 600,000 US deaths because of COVID-19, that's with a population today of about 330 million. back in 1918, the population of the US was about 100 million, and 675,000 people died in that event. Real enormous tragedy. But through it all, if you take a look at the stock market, it actually did just fine and went down a little bit after that. But at the turn of this particular decade, in the 20s, the stock market went on a tear, so much so that we now refer to that period as the Roaring 20s because of such incredible growth and strong market performance. So strong, in fact, that it led to the 1929 stock market crash because there was so much margin buying of the stocks in the stock market that at some point that leverage wasn't sustainable. I'll come back to that a little bit later on. But the point of this is that because the pandemic was not described in the news, and because we did not engage in any kind of interventions early on, it spread like wildfire, killed a lot of people, unfortunately, that could have been prevented. But it turns out that because we were in the midst of a war, we had different priorities. But in the end, financial markets were largely unaffected, and economic growth actually continued beyond this short period of interruption, as we described. Now let me turn to the second example, the financial crisis of 2008. This is another example of a traumatic event in financial markets where a number of financial institutions were hit pretty hard. We experienced a deep recession, tremendous loss of employment. About 9 million jobs were destroyed during the course of that financial crisis. And it took us quite a long time to recover with unprecedented intervention. All sorts of various kinds of government facilities were launched. The Dodd-Frank Act, a major rehaul of our financial regulatory infrastructure, and about $700 billion authorized for government intervention in dealing with the so-called toxic assets and other sources of financial market distress. If you look at the process of getting back to work after that financial crisis, it took a tremendously long period of time. So this is US total employment, non-farm payroll from 2006 to October of 2020. Actually, I think I've updated this, so it includes it to the most recent quarter. If you take a look at this recession, it was pretty deep. We lost a tremendous number of jobs. And in terms of how long it took us to get back to just to get back to the pre-financial crisis days, it took nearly 7 years. 7 years before we get back to the employment levels that we saw before. And of course, if you take a look at what's happened during the pandemic, a much sharper decline, much more rapid, but also a recovery. We're already more than halfway back, and estimates are we're going to be back to pre-pandemic employment in a matter of 1 or 2 more quarters. If you look at GDP growth, well, clearly it took us a while to restore the amount of GDP that we're producing, and several years, whereas in the current case, where we are right now, we have already exceeded our pre-pandemic GDP levels. So for all intents and purposes, we're actually pretty much back from an economic perspective in terms of productivity. And it's going to take us a little bit longer, but we expect to be back in terms of total employment. So that's the picture in terms of historical perspective. Some differences, but some similarities. Let me now talk about financial market implications. Sorry about that. So let me first begin with a quick market recap. And the market recap starts in 2019. If you look at this chart of the MSCI World Stock Market Indices, you'll see that pre-2020, nobody was worried about what was going on in financial markets. In fact, in 2019, the MSCI was up almost 30% for the year. So going into 2020, the real question was not, gee, is the market not doing well, but rather, is this sustainable? Is the market overheated? Do we need to worry about things going too well. And so the point of this is that when we go into 2020, nobody was talking about financial crisis. And so now let's talk about what happened during 2020. So this is a graph of the S&P 500 and the NASDAQ. And you can see when the pandemic hit the United States in the middle of February, that's when the stock market started going down. And it went down for several weeks. It wasn't until towards the end of March that somehow a bottom was reached and people figured out that, well, you know what, maybe things aren't as bad as they seem. So if, in fact, you simply highlighted the period when markets went down through March and then looked at the recovery afterwards, and you simply got rid of a few of those weeks, just snipped it out, and then you just put the chart together, what you notice is that it's like there's no pandemic. Apart from those few weeks, markets are back. Why is that? And it turns out that it has to do with fear, what I call the 5 stages of financial grief. This is an homage to the psychologist Elizabeth Kubler-Ross, who came up with the 5 stages of grief: denial, anger, bargaining, depression, and acceptance. And we actually go through a very similar set of stages of dealing with financial grief. There's a period where we freak out and we pull our assets out of the risky and into safe assets. Eventually, we realize that that's really not a good idea. That's not necessary. And then we rebound and we put money back in. That brings markets back up. And then at some point, we need to start recalibrating and trying to figure out what the new normal is going to be. And then the 4th stage is we finally adapt after we recalibrate. And usually after that period of adaptation, there's a period of tremendous growth when we've not only figured out some of the issues we were dealing with, but we've actually been able to deal with those issues and then move on to the much more profitable and effective type of economic growth. So if you actually look at the performance over the course of the last few months, we actually see these different stages. So this is data that was put together by the NYU finance professor Aswath Damodaran. He puts together a really fantastic blog, so I would encourage you all to take a look at his website. What he shows is that the period from the middle of February till the 3rd week of March, that's the period where we've all freaked out, the 1st stage of financial grief, and tremendous losses around the world. But if you go from March to September, you see that there was a pretty significant rebound and markets are back. And from September to the end of 2020, that's the period of recalibration. And he doesn't put it in these terms. These are my terms, but they're very visible when you take a look at what's been happening around the world. And that process, that 5-stage process, is really all about adaptation. And the adaptation brings with it new winners and losers. So one example of a winner, which is what I'm interacting with you now on, is Zoom. Zoom has done tremendously well from the beginning of January through about the middle of October. It had a phenomenal run. And it is a major force in our lives because of the technology that it's produced. The pandemic was the perfect catalyst to make Zoom a mainstream player in global markets. However, as well as it's done, any company is going to be facing challenges. And not surprisingly, since October, Zoom has had its share of difficulties, both with competitors, security issues, scalability, and so on. It's still done quite well since the beginning of 2020, but clearly it is adapting. Now, what about losers? Well, one example of a pretty significant set of losers is cruise lines. So here's Carnival Cruise Line, till around the same point where Zoom hit its peak. It got hit pretty hard obviously not only because of the pandemic, but because of the fact that, when you're in the midst of this kind of a pandemic, you don't want to be trapped on a ship. So the whole idea of being sequestered in a floating petri dish was not anybody's idea of fun. Now, some people wrote off the cruise industry and said, well, this is pretty much the end of it. But the cruise industry adapted too. And so since October, Carnival has actually done quite well. They're still down relative to the beginning of January, so they're not at pre-pandemic levels. They've lost a lot of market value. But the fact is that people still want to go cruising. And so cruise lines, as hard hit as they were, still have a future. In fact, if you think that people aren't interested in cruising anymore, here's an interesting fact. The number of cruise bookings for 2021 has actually exceeded the pre-pandemic levels of 2020. That's right. Far from being scared away from cruises, people now recognize that there are ways of dealing with these infections, even if you're on a ship out at sea. And so there is tremendous pent-up demand for cruises. The point of this is that these changes in market environments produce adaptations. Companies don't simply sit still and let these market events happen to them. They react. And we actually see this in the performance of various different sectors. So this is also from Aswath Damodaran's website. He looks at performance over the course of the pandemic across different sectors. So from mid-February to September, you can actually see in terms of the changes in total market cap of these sectors, who the winners and losers were. And not surprisingly, some of the losers were oil and gas, real estate, reinsurance, aerospace and defense, air transportation. These are all industries that are not going to do well in the midst of this pandemic. And it's simply a recognition of the fact that it's very difficult for them to adapt. What about the industries that have done really well? Not surprisingly, software, online retailers, healthcare, home furnishings, transportation. These are examples of things that were staples that we really needed to rely on during the course of the pandemic. But what's even more interesting is these two other facts that Damodaran documents. One is if you take a look at companies by their age, their chronological age, and you rank them by youngest to oldest, and then you look at the market cap changes in those deciles over the pandemic, what you notice is that the oldest companies are the ones that lost the most market value. And the ones that did the best were the youngest companies. And if you look and rank them not by age, but by revenue growth expectations, what you see is that it's really the high growth companies that have done really well, and the slower, more maturing companies that have actually gotten hit pretty hard up here. So this is, in a way, a changing of the guards, and the fact that youth seems to be winning out over age. It's obviously much more complex than that, but that's certainly one element of the narrative. And so we're actually seeing even more dynamical changes in the global financial system that my colleagues, Monica Bilio, Loriana Pelizan, Mila Getmansky-Sherman, and Abi Zarai have documented in a recent working paper. We looked at the behavior of 12 ETFs, each focused on a particular country's performance. So it's country-focused stock market indicators that investors put money in. And because it's an ETF, it trades every minute of the day. So what we did was to take a look at the minute-to-minute returns of these 12 country ETFs, all of which trade on US exchanges. So they're during the same trading hours. We don't have to worry about different time zones. So these 12 country ETFs are trading at the same time during US trading hours. And the question that we ask is, can we document the relationship between minute-to-minute changes for one country ETF versus minute-to-minute changes of another country ETF, either a minute ahead of time or a minute before? In other words, what we're trying to get at is, are there relationships among the trading of these different country ETFs? And if so, what do those relationships look like? Are there certain countries that are more important in forecasting changes of other country ETF movements? And what we were able to do is to use these statistical relationships and put them into a graphical network, something that I'm sure all of you have seen, like a social network, where a line is drawn between one country ETF and another country ETF if it turns out that movements in one generally predict movements in the other one later. And so by doing that, we can identify the key hubs, the key ETFs that seem to be explaining movements in all of the others. And you probably won't be surprised to learn that the United States, for the most part, over our sample period from 2012 to the present, that the US has been largely responsible for predicting movements in other countries. That is, the US markets are dominant. So this is a graph that basically highlights in color coding which country ETF is the most important in predicting movements of other country ETFs. And the United States is in blue. And you can see for the most part, the US is the dominant ETF in terms of explaining other markets. If you take a look at the very first illustration to the extreme left, that is an example of a network on a given day where the United States is in that blue node, and the size of the node is proportional to the amount of statistical impact that it has in predicting other country ETF movements. And you can see that for the most part, starting in 2012 with our sample, the US is the dominant force until now. Over the course of the last 2 or 3 years, it's changing. So in the middle of the sample period, you can see another snapshot where the US in blue is still important, but it's not nearly as important as it was at the beginning of the sample. And towards the end of the sample, you'll notice that actually for a few periods of time, China has actually become more important in explaining market dynamics for the other countries. In fact, what we're seeing with the data is that the world has shifted from a unipolar to a bipolar system, where it's no longer just the US that has been dominating financial market dynamics. It's now a combination of US and China. And there are two specific events that have exacerbated this transformation from unipolar to bipolar. The first is the trade wars that we undertook. That trade war ultimately ended up making China far more important in the global landscape. And the second is COVID-19, that during that pandemic, it turned out that that also added to the relevance of China in financial market dynamics. So that's an example of how the system is changing. And by understanding these dynamics, we can better predict what will likely to happen over the course of the next few years. So in the last few minutes, let me try to put this all together and wrap it up and explain what we can draw from all of these various different disparate facts. The first point to make, which is an obvious one I know to most of you, but I have to say it anyway, just for completeness. We are not facing a financial crisis. What we have instead is a public health crisis that has some pretty significant financial implications. We have purposely induced a medical coma that, using the analogy, when you suffer brain trauma, you are put into a coma until the swelling in your brain goes down to protect the your brain. And so this medically induced coma that we put the world in is responsible for the economic impact that we've seen. And because of that, just throwing money at the problem is not necessarily enough, in contrast to the financial crisis of 2008, which emanated from the financial sector. And so we have to be very careful in terms of dealing with the source of the crisis, which in this instance is not the financial system. It's really a public health crisis that we're dealing with. And in particular, it's really fear and uncertainty that we have to battle. Those are the key issues. So therefore, the best policies, and some of the policies that we have followed in this country and in others, are policies that reduce the fear and uncertainty throughout this period. That's the key. Certainly developing therapeutics, developing vaccines, being explicit about where the infections are coming from. Are they growing? Are they declining? What we can do to deal with them. Those kinds of facts and interventions help reduce fear and uncertainty. Monetary policy, on the other hand, may not be the most effective type of response. And some of the questions that were submitted ahead of time really reflected exactly that concern. The banking system is being used as a tool to deal with the pandemic. Is that really the most effective way to do it? In my opinion, the answer is no. But more importantly, from the framework of adaptive markets, it's pretty clear that that is a temporary Band-Aid that is not necessarily going to deal with problems on an ongoing basis. So using that lens of adaptive markets, we can actually see what's going to happen short run, medium run, long run. In the short run, we're going to see higher periods of volatility, meaning that market volatility may be relatively stable, but if there's a resurgence in infections, if there's some ineffective policy, if it turns out that we see dangerous side effects of a particular vaccine, the market will react negatively, volatility will spike. So there may be recurring periods of instability as we are getting back on the path to a full recovery. And some of the reopenings that we've seen may be reversed as a result. For example, Taiwan, which is a country that has managed this epidemic crisis beautifully, being very proactive at the beginning with contact tracing, with providing masks and so on. It turns out that Taiwan is back on lockdown now because it has experienced about 300 COVID cases where they weren't able to track the particular people and they weren't able to get them to respond to information requests. So the reopenings may be reversed, but then there's going to be mounting economic and psychological toll. But the fact is that the stock market, observing that this is a temporary phenomenon, will react positively and anticipate the fact that the economy is going to get back to normal sooner rather than later. In the medium run, which is 6 to 18 months, we're going to have even more vaccines, treatments, testing, herd immunity, and more effective government policies. Countries will reopen permanently. Economic recovery will begin in full swing. And the stakeholders around the globe and in various different sectors are going to adapt to this new normal. And of course, there will be new winners and losers. Third, in terms of the long run, what do we like to see? Well, one of the things that was pointed out earlier by a number of you submitting questions was the concerns about the implications for the long run, particularly with regard to inflation. So I'm going to ask Patsy to please launch a poll just to solicit your opinion about what inflation is going to look like over the course of the next 3 to 5 years. But the long run perspective from the adaptive markets focus is really that we're going to see a period of very, very strong economic growth, the roaring 20s of this century. And it really comes about because this idea of adaptive radiation. This is not nuclear radiation. This is the idea that when you have some kind of environmental cataclysm, in the aftermath of that cataclysm, all sorts of ecological niches will be open for new entrants. And that means that different species will radiate, the family tree will radiate in many, many different ways because of innovation, competition, and the emergence of new species, as we are seeing right now. There are clearly new species that are taking hold, and we're going to have to think about what that implies for our financial system. Of course, the concerns are potential problems with inflation. We're doing a lot of government intervention. We're stimulating the economy in ways that we haven't before. The amount of money we're applying to that stimulus is on the order of 2 to 3 trillion here in the United States, way more than what we did in the aftermath of 2008. That also has implications for inequality. If you thought that the impact of automation on the workforce was significant before the crisis, well, you can speed up your forecast because it's only increased the speed with which this kind of automation is going to have an impact on employment over the course of the next few years. And finally, I think that what we're doing right now is planting the seeds of our next financial crisis. We have to be extremely careful in how we recover and when we take off the government policies that we're putting in place. And clearly, inflation, can be an issue if we're not too careful. So, Patsy, can we share the results of the poll about how people are thinking of inflation?
Absolutely. It's pretty interesting, Andrew. I'm going to share it right now.
Great. Okay. So the choice A was little or moderate inflation in the US over the course of the next 3 to 5 years. B is moderate to high inflation over the course of the next few years. And then the last two choices, C and D, are deflation, and then E is none of the above, something else. Well, that's F. E is going to be no significant effect. Well, so I think that there are some real concerns with inflation, as many of you have expressed. But before you automatically assume that that's what's going to happen, please keep in mind 2 things. Number one, going back to history, we actually didn't see a lot of inflation over the course of the last 12, 13 years since 2008. And you might ask yourself why that is. It turns out that 2 reasons. One is that because of increases in productivity and the ability to export jobs and therefore reduce wage inflation by using other cheaper sources of labor, that attenuates the inflationary pressures. But the other reason is the debt overhang. The more amount of debt that's issued, the more that ultimately ends up reducing productivity and therefore dampening inflationary pressures. So it's a little bit more complicated. The standard historical knee-jerk reaction is, yes, when you stimulate the economy, you're going to create inflation. But there are some counteracting effects that will actually change the way these market dynamics work. So we need to be mindful of that. Okay, so in conclusion, someone once said, probably was a hedge fund manager, the market can remain irrational longer than we can remain solvent. And that's something that you need to keep in mind. You need to be wary of changes in market conditions, particularly given the kind of technological innovations that have really affected markets, social media and its impact on GameStop and other market prices, Bitcoin, non-fungible tokens. These are all part of the new generation of financial assets that may or may not be long run viable and may create certain dislocation. In the end, what really matters is for all of us to adapt to these changing market conditions. And this was brought home to me in a very personal way years ago when my younger son was celebrating his 5th birthday, and my older son, who was at the time 10 years old, was really jealous of his younger brother because he was getting a lot of attention. So he told his younger brother, Wesley, today you're turning 5, but I'm 10. I'm twice as old as you. I'm twice as tall as you. I'm twice as strong as you. I'm basically just twice as good as you. And that got his brother very, very frustrated. And it wasn't until a few hours later that the younger sibling came up with a response. He was very happy. His face lit up, and he ran to his older brother and said, Derek, you're twice as old as me, right? Derek said, yes. And then the younger brother said, well, that means you're going to die first. And so if you understand that sentiment, you understand adaptive markets. Thank you.
Well, thank you so much, Andrew. This is really fantastic. We have quite a number of questions that have come in. So the first question I'm going to start with is, does the pre-COVID fear of an overheated market remain, or did the March 2020 crash and near immediate correction sufficiently serve as a hard reset, negating those old worries?
Well, so, I'm not sure that there's a consensus on that. It's a very important question to ask. I can tell you what my perspective is and what I've heard from the various different Wall Street pundits that I read. I think that there is still a concern that markets are pretty lofty in terms of their valuations. If you look at PE ratios and other kinds of metrics, it does look like there's a fair bit of optimism, but that optimism needs to be also coupled with the fact that we're engaging a fair amount of stimulus. So market level prices are reflecting both. And certainly if the underlying productive capacity of the US economy, which is largely what has driven the US stock market, if that continues to develop the way it has, particularly certain areas like technology and biopharma, then I think that the valuations may be supportable over the course of the next 5 to 10 years. But there's a lot of growth that is baked in to current market prices. And so if there's any kind of disruption in those kinds of technical advances, it may well be that it's going to be difficult to support these kinds of valuations. My own opinion is that over the course of the next 5 or 10 years, we're likely to see a very strong period of economic growth, but not for the reasons that people have cited. It's really more for the evolutionary reasons that I described. It's that the course of the last year has allowed companies to basically reorganize themselves, and the ones that can't are now out of business. So it's been a bit of a cleansing of the system, if you will. I don't take any pleasure in saying that because there are a number of people who've lost their livelihoods and jobs and family-run businesses have been wiped out. And so it's been a terribly traumatic event from the human perspective. But from an economic perspective, what it means, the old Nietzsche saying that whatever doesn't kill you make you stronger, I think that really does apply to markets and companies in particular. So the fact is that we've gone through a 1-year period of restructuring, and typically after that period of restructuring, you're going to see very strong economic growth. So my own perspective, but there are a number of people that I'm sure would disagree with me, my own perspective is that in the long run, and by the long run, I'm looking at the next 10 years, I think that we're going to see a period of tremendous economic growth. And therefore, I think we're going to have the potential for another financial crisis.
Great. Thanks, Andrew. To drill into the stimulus question, we had another question come in. Would we be seeing the same growth in the stock market, crypto, real estate, et cetera, if the COVID stimulus and corresponding fiscal changes had not taken place?
Well, so, you only have to look back to that chart that I showed you of the MSCI to see that markets were on a tear, prior to 2020. And, with markets being up nearly 30% in 2019, would they have gone up another 30% in 2020? I don't think so. But my guess is that it was with such momentum and so much growth in demand, it seems that markets were going to be pretty strong. And certainly, since then, markets have gone up substantially. But I think we would have seen a very different set of winners and losers. So no doubt technology would continue to be strong, but I don't know that healthcare would have done as well as it has. And I don't know that Zoom video would have done as well as it has. So I think that the winners and losers have been affected tremendously by the pandemic. But overall, markets were actually heading in a pretty strong direction even before the pandemic. So the best guess was that it would have continued going, probably not quite as steeply as it was before the pandemic, but there was so much momentum going into 2020 that I think that it really would have continued for at least another year or two. And really depending on what the underlying productive capacity is of companies, both in the US and abroad.
Great. So we have another comment here about modern monetary theory. So as a result of the massive stimulus actions taken to keep the US economy upright, can you speak to this theory, the modern monetary theory, and its potential impact to the US economy?
Yeah, so this is a really interesting question that I think economists don't even agree on. The idea, it used to be the case that if you engaged in massive stimulus, that would ultimately cause hyperinflation, that would undermine a lot of the gains. And so modern monetary theory is basically trying to rewrite that perspective to say that no, actually monetary policy can have long-lasting effects. And the underlying assumptions implicit in modern monetary theory has to do with frictions as well as behavioral arguments about individuals and large groups of investors reacting to risk. It provides a role for government to intervene when we see these kinds of economy-wide shocks. So the question about whether or not modern monetary theory really works and is appropriate, I think it's anybody's guess at this point. We don't have enough experience. And in fact, it was only developed and it only emerged because of the financial crisis and what we saw in its aftermath. The fact is that modern monetary theory, this quantitative easing and interventions, it did work. It did work in 2008. And unfortunately, I think the lesson that we learned from 2008 is we need to go bigger and go faster. And I think that's what we ended up doing. We ended up, engaging in this, $1.9 trillion stimulus package that was authorized in March. And I worry that we've overdone it because we learned perhaps the wrong lesson from 2008. So I agree that modern monetary theory does have a role to play in changing the outcomes of these kinds of market dislocations. But every benefit has a potential cost, and you can always overdo a good thing. So what we need to think about is when we're going to be taking off the stimulus that we've put back on. It's a lot of fun to hit the accelerator pedal, and everybody likes going faster. Nobody likes hitting the brakes because that's not fun. And yet that's necessary for us to prevent ourselves from going into another financial crisis. So I'm hoping that we learn not just how to hit the accelerator, but we also learn that we need to start thinking about putting on the brakes.
Hard to slow down when you have that much momentum, right?
Exactly.
A question related to the model regarding outsized impact of US and China on other countries' ETFs. If you looked at the gains over the study period of the other countries' ETFs, what countries project over the coming few years to show excess growth?
Yeah, that's a really, really interesting question. We did not look at that, so I'm going to have to go back and look at the data. My informal guess is that it's actually the smaller developing countries that have actually shown the most potential for growth. US and China, as important as they are, it's not clear to me that they are going to be the growth engines of the rest of the world. Clearly, China has been growing tremendously in terms of its economy, but foreign investors have not necessarily shared in those gains as much as you would have expected, given how quickly their economy has grown. So I think that it's an open question that we have to look at carefully. And I would say even looking at the ETF data, I'm not sure is indicative because, as we all know, past performance is no guarantee for future success. So we have to think a little bit more about where the population is growing and where markets are growing. Sub-Saharan Africa has a tremendous potential that few economists have focused on in recent years. because it's developed a little bit more slowly than people expected. But with with COVID-19, I wonder whether or not a number of the online businesses that have shown tremendous promise, whether they will make faster headway in that region of the world, and if so, just by sheer population size alone and the rising of the middle class in Africa, that might be a tremendous potential for growth. So I think that our analysis focusing on ETFs doesn't really do justice to the question that you're asking. And it requires some further analysis, looking at the underlying demographics to really be able to get at the kinds of question that you are looking to answer.
Thank you. So this question is sort of related to the work that you are doing with this analysis. So will you keep the analysis on network centrality up to date and publish the results on a periodic basis? They said that this would be very useful.
Yeah, we're trying to be better about that. So I appreciate it. Thank you. We would love to be able to do that. We're seeing whether we can automate some of this so that we can just post it on our website and have it update automatically. The challenge for us is that sometimes the data vendors don't like that, but I think we can probably do it, a 1 quarter in arrears so that we're not competing with Dow Jones or Bloomberg. But yeah, thank you for that suggestion. We will definitely try to put that on our websites and keep it updated.
Amazing. I mean, you are one of the most active published faculty members at MIT Sloan. So I know that you provided some papers on the session page. Do you have anything to recommend our viewers look at pertaining to those papers?
Yeah, so we put our paper on this global dynamics, in our session. And so that's certainly something to take a look at. You can read the details of how we did the analysis. And that paper also cites a number of other papers in literature on using network analysis. This is one of the cool things about technology. It actually has all sorts of side benefits. So one of the benefits for us is that we now have access to larger amounts of data in a more timely fashion. And we also have access to tools that we can use like network analysis. So the kind of information we use is very much along the lines of what Google uses to figure out what web pages to deliver up to you. They calculate a network of different internet sites and searches, and they figure out what the important nodes are, and they are able to use that to serve it up to their users. So yeah, I think that we definitely encourage you to take a look at that paper, as well as the references that we cite. The other paper that I included in the session, because I've gotten questions from a number of alumni and colleagues about the online platform that I've been using to do teaching. It's a little bit different than the usual Zoom share screen, mainly because we wanted it to be a little bit more of an interactive experience. We wanted to make it seem like students were in the classroom with us and us in the front. So if you're interested in the online platform that my colleagues and I use, we put a research article about that in the session as well.
Fantastic. So we have time for one more question and then we'll wrap up. So sort of pertaining to your, if you will, suggestion that we are headed into a roaring 20s, what do you think will be a new trend in the financial market that we might not have observed before?
Well, the main trend that we've seen over the course of the last few months is the impact of social media on financial market decisions and investments. The GameStop episode with the Reddit sub-channel, I think has been a really interesting wake-up call to thinking about financial market stability. And I know that we're going to see new regulations put in place to deal with that. It's going to take a while because we need to understand the implications of the technology. Social media is a great equalizer in allowing people to share information. But when you go from sharing information to turning into a kind of a gang mentality to take down a company or to prop up a company, surely because you can, and surely out of spite, that starts to look like market manipulation. And I think we understand that doesn't make for fair and orderly markets. So I think that trend of using technology to have a direct impact on financial market dynamics, that's something that we haven't really seen to this extent, and we're going to have to deal with that. And fortunately, we have a phenomenal SEC chair, Gary Gensler, who, as many of you know, was at MIT for the last several years as a professor of practice. And Gary was a phenomenal colleague in teaching a course for us on digital currencies and financial technology. I couldn't imagine a more qualified person to be in that role to help us navigate these kinds of financial market gyrations than Chairman Gensler.
Great. Well, thank you so much, Andrew. It's always such a pleasure to hear from you and hear your insight. And I look forward to following these updates that you'll be doing to your research. And I just want to thank all of the attendees today for joining us. We had a phenomenal first day of our reunion sessions. So at this time, we will conclude this session, and we hope to see you for the continuing programming that will go through Saturday.
Thanks very much, everybody. Good to see you all, and I hope to see you in person next year, if not sooner.
Absolutely. Take care.